Hello and welcome. This is Thank or It's Friday. Well, we're looking at interesting times for Indian equity markets, considering the fact that there's no lack of steam from the bulls. However, there is also some concerns with respect to the valuations as to where we see levels for now. So what do we do right now? Well, let's get some help. We're in conversation with Mr. Tushar Pradhan, the Chief Investment Officer at HSBC AMC. Thank you, sir, for joining us today. Well, I'm going to start off with the fact that if you consider the valuations at which the Nifty or the Sensex is trading at, it may not give you a real picture of the valuations. But I'm just considering the relatively overvalued stocks for now. There is an argument building now that it doesn't matter that they are overvalued because they are not peak valuations. What is your opinion when we approach these kind of stocks right now? And are you also of the belief that there could be some more headway before we can see some, consolidation there?
Well, I think we need to put all of these numbers in perspective. And many times people jump to this conclusion that we are overvalued. I think we are overvalued considering the fact that we have not had any change in earnings practically for the last 3 years.
Right.
And over the last 2 years, the stock market has gone up, which
Yes.
means that there has been a re-rating of the market.
Yes.
So currently we are not talking about overvaluation, we are just talking about a re-rating without any increase in earnings, which means that the focus turns to FY18, which we are already in, which is called the current year.
Right.
Now if you're talking about 1 year forward, we have to talk about FY19 numbers.
Yes.
Now on that perspective, whatever consensus earnings are there for FY19, this market trades at around 16 times that number.
Right.
So now you tell me, whenever you talk about 1 year forward, I think the 15-year average is around 15.
Yes.
And here we are talking about FY19, which is 1 year forward.
Right.
Technically,
Yes.
is 16 times. So in that sense, I don't see that much of an overvaluation really in that
Okay.
sense.
Okay.
So that's correcting, this perception about overvaluation.
Right. Okay.
Second is when I look at the earnings estimates for the next year, and if I become more granular, whether you take Nifty, whether you take Sensex.
Right.
Now, as an average, you come up with an EPS number for the average.
Yes.
But if I take each of these companies separately and I say where is the delta going to come from to get to say 19% earnings growth in 18,
Yeah.
I think all of them seems pretty positive because each of the companies which have had a lot of challenge this last financial year are expected to just go back to normal.
Right.
So we're not
Yes.
expecting a very large surge in earnings really in that sense. And there may be some companies which may disappoint, but I think on the whole, if you look at the total number of earnings which we're expecting for FY19, I think we are more or less in territory which is not really very exciting. I think which is probably normal. And I think they seem a lot more double-digit earnings growth for the next 2 years, only because for the last 3 years we've had practically flat earnings.
Right.
So again, a correction just to normal is not really that much to expect.
Right.
And on top of that, if you're trading at 16 times, and I think markets, the reason why they're so strong, I think probably the secret behind that is this.
Okay, so if I keep the base effect aside, what are the other factors on a macro level that could drive earnings forward?
Well, I think there are many things which we talk about for earnings growth. So one of the biggest is GST, as we are all
Yes.
talking about. We believe that there will be a pretty significant improvement in the operating environment for listed companies. So one is the argument about how is GST going to affect the economy
Right.
and the government revenues and how many more businesses become more organized, which is a separate issue altogether. But I think we all have to agree that GST is extremely positive for the listed universe. So let's say I would think a broader organized market.
Right.
Because what will happen is that the insistence on a GSTN number will ensure that your supply chain will start to become GSTN compliant.
Right.
And once that happens, it is easier for an established company to actually be part of a supply chain as opposed to an unorganized company.
Yes,
I mean, everyone is now asked that their vendors should have a GSTN number. Now, what that is going to do is that people already in the system will just see their market share expand.
Right.
Because people who are either unwilling to or they think that the new regime is something which they cannot survive in, they will just be weeded out of the market.
Yes.
But the market share of the available demand will just spread to someone who's more organized, who already
Right.
has that setup.
Yes.
So I think that is a very significant driver of earnings next couple of years, and I think
Right.
we have to wait and see how fast and how large that happens. So that's one big driver. The other driver, I believe, is this overhang of the bad assets that the banks have, and we are all understanding the fact that everyone from the government downwards is very interested in solving this problem.
Right. Yes.
So you have accumulated losses, you have significant provisioning, which is really destroying your earnings potential, is actually going to come on stream in some way or the other.
Right.
What solution? I don't know. But I think once we start bottoming out of there and the slippages starts to come off,
Right.
then you're going to see a pretty significant surge in earnings per se.
Right.
So these are two very strong, I would say, vectors which will drive earnings. And we are expecting that the earnings slowdown that we have seen for the last 3 years is bottoming out. We are seeing a lot of public sector ordering. We are
Right.
seeing infrastructure orders coming through. All of those reported earnings are also starting to build up.
Right.
You have significant reduction in earnings in interest rates, and as a result of which your margins, which were really in trouble because of the very high cost of borrowings,
Right.
that having come off almost between 200 to 250 basis points for most people,
Yes.
I think that's going to also go down to your bottom line.
Okay.
So there are pretty significant factors out there which we believe the earnings growth can come without having to have a significant economic revival.
Right.
So I think beyond the base effect, I think there are so many things that we can look forward.
Okay, so you partly answered my next question that has to do with banking and NPAs. The RBI has changed its stance to being neutral from accommodative. However, there is still, some voices out there who say that there could be more rate cuts going forward because of the kind of inflation and the trends that we're seeing in inflation. How are you reading this picture?
It's a tricky one because if you look at where the interest rates are today and where inflation is.
Right.
So when we were having inflation expectations of 4.5% in January,
Yes.
and second half to be 5%, that was more or less easy to beat.
Yes.
But now that the expectations themselves have been brought down significantly, where is the room for a surprise?
Yeah.
So it's actually quite convoluted in the sense that you have actually reduced your expectations, so your potential for beating it is now that much lesser.
Right.
Now the government also expects inflation to come down,
Yes.
and that's part of their long-term plan. So if you look at where it is 625 repo, where can it go down to with expectations of 3.5% in terms of inflation? You and I can guess, because I don't see it surprising all the way down to where their expectations now
Right.
are, and they all say that there is going to be some core inflation stickiness. There will be some revival of inflation in some pockets,
Right.
and that will kind of make it a little volatile. Our guess is that for a long period of time interest rates are going to be stable.
Right.
So without breaking either it on the lower end, nor having a substantial spike as a surprise going up.
Right.
I think we are in for a period of pretty significantly comfortable liquidity and stable interest rates.
One of your funds has a substantial allocation to the NBFCs, and you have also recently spoken about that maybe there could just be a little bit of a bubble with respect to this particular space. I noticed a lot of HFCs in there, just one microfinance company. So let's just start off with HFCs right now, and I'm going to come down to the microfinance aspect later on.
I think it's a no-brainer to see that there is a lot of advantages to being in the HFC sector.
Right.
One is that in this country there is genuine demand for housing.
Yes.
What gets obfuscated or what gets really not seen so much is the genuine demand, because either it's unaffordable or the fact that supply where it is required, the demand being the highest, which is in the middle sector, supply is not available.
Right.
So we always are in this situation where we are unsure of how this housing demand really plays out. So in a sense, because of the thrust on affordable housing, because of the real bind that a lot of these builders have and the developers have on this super luxury side, we are seeing the genuine demand in housing starting to come back, and
Right.
that is where the HFCs squarely position themselves.
Okay.
So the HFCs are not looking at the super luxury because they don't really borrow, they
Right.
have their wealth,
Yes.
and the very low, they don't really go because there is no income sustenance on loans going out to 10, 15
Right.
years. So your middle section, which was under severe pressure because of the prices being completely out of reach and the supply not just matching the demand, now we're going to see a significant structural change there, where suddenly this market suddenly expands.
Okay.
So most of the HFCs were struggling for growth for the reasons that I described.
Right.
But now suddenly with these factors playing, then it appears that maybe, and of course with some benefits which have gone to the HFCs by way of some changes that the RBI has done, that also improves their resourcing ability.
Right.
And so you have on the one hand their ability to raise money now a lot better than before, and then the expansion of the market itself.
Right.
So I think they're set for a very interesting time, and I think we were pretty prescient. I would say my fund managers and analysts were really on the ball when they decided to be overweight HFCs.
Okay. And we've seen a lot of weakness in several of these microfinance companies, but there has been an increase in allocation in at least one microfinance company. We don't need to name it, but what's going on here?
Well, I think microfinance gets a bad rap
Okay.
because of the fact that it had an experience in the past. So we had a probably just one example of where there was a state which there was pretty significant distress across the space.
Yes.
People today are talking about a couple of states where such a situation may reoccur. But the fact remains that this is, like in India's case, we call it the great unwashed. Like I would liken it to say that this is the great unbanked.
Right. Yes.
Right. So I think the banks don't want to go there. NBFCs really don't have the network. They don't have the connect with the eventual borrower. So I think the MFIs really do a lot when it tries to identify enterprise, which is across the board. So you talk about any state, about any economic level. There are a lot of entrepreneurs out there which just don't have the quality of finance available to them.
Right.
So the MFIs do satisfy a pretty significant demand in the environment. The way they are managed now, I must say that some of these MFIs really have fantastic managements. They understand the business. They know where to get the money. The yields are, you can see them.
Yes.
There are 21% yields on the book, which are not really weak or bad in any way. All you have to do is to manage your borrower. You need to understand who your borrower is.
Right.
And if you are with them, and it's been amply demonstrated for so many times that if you really understand the cycle of how the small borrower actually works, you can work with them, and they are absolutely fantastic borrowers.
Right.
And the larger you're spread out, I think the risks start to come off a little bit. So in a sense, I think we've been a little skeptical about this space. But I think if you do your research well, and you identify a certain niche that an MFI may focus on,
Right. Yes.
I think you have a great proposition in front of you. As I said, apart from that one significant event in the past, MFIs have really delivered very well.
Right.
However, I must say that one has to tread with caution, because a lot of NBFCs think that MFI is just so easy to do.
Yes.
Because it's so high yield,
Right.
all I need is some capital and I'm off. While it may appear to be that easy, all of the entrepreneurs out there, I don't think understand the MFI space as well.
Right.
So one should be careful to say that just like all mid caps are not the same, all MFIs are not the same.
Sure.
You need to really assess the management there.
All right. A lot of broking houses are now taking contrarian bets on the information technology sector, but I also want to address the fact that the kind of guidance they've given for FY18 is not, something that looks good to a regular investor. What do you do with something like this?
I think here it's a little bit of expectations management rather than the actual fundamentals of the business.
Right.
If you look at margins, I think they continue to remain healthy. If you look at growth rates, of course, compared to historical growth rates, they're not as good as they were. But you should imagine that now most of these companies employ, especially the larger IT companies, employ more than 2 lakh people per company.
Right.
And we are talking about very large enterprises
Yes.
with huge top lines. So for them to expect that they will get double-digit revenue growth every year from here on, itself kind of defeats the whole size issue, right? So yes, they will grow a lot slowly than before.
Yes.
But they continue to have a proposition which is attractive as an offshoring alternative. There is a lot of noise here. So whether you talk about the US administration, whether you talk about the visa issue,
Yes.
there's a lot of noise there.
But that's noise. That's just noise.
That's noise because nobody really knows.
okay.
So I'm not saying I know any better.
Okay.
But
Alright.
I don't think there is any facts out there which have made it very clear that the
Okay.
space is closing up or
Right.
opening up. No, nobody really knows. And there are many things which I've just recently discovered that the visa issue is really not that easy. It is not up to any one individual to decide what the quota is.
Right.
The US Congress actually votes on this quota, and which means that you need bipartisan support to really
Right.
change anything there, which
Yes.
again, everyone knows that, the fact is that the demand in the US is still very high. Why is it that they hire foreigners? Simply because they don't have the people themselves.
Right.
So that's not going to change overnight.
Yes.
So I don't think as a proposition as why the Indian IT companies are there in such a large scale, that's not changing. Yes, there will always be market challenges. The environment will change. The area in which IT spend starts to grow and wane will always keep changing. But that's
Right.
something which we've been used to for so long. So I don't
Right.
think there is any structural issue. I think it's more to do with expectations management. It's more to do with the fact that people just assume that they will make supernormal margins forever, and they just assume that no matter what they do to their capital structure will be ignored by the market at all
Right.
times. I think there will be some reversion to some sanity at some point of time, but I think sheer valuation should be a guide here.
Right. Okay, so I'm going to come to the part where a lot of our young viewers pay a lot of heed to. This has to do with the kind of investment philosophy that you employ. And I was going through this one portion where you have spoken about how you take the return on equity and you pitch it against either a price to book multiple or a price to earnings multiple, and then you decide how expensive it is relative to
The
its
rest of the
peers.
business, yes.
Can you tell us a little more about that?
Yeah, I can go on forever on
Yes,
this one
sure.
because see what happens is generally people profess that they invest in a certain way,
Yes.
but many times you change that strategy because you think things have changed, and I think that's the cause for many people to lose track of what they do.
Right.
I'm not proposing that any one investment philosophy is the best
Yes.
because
Yeah.
at times the styles differ. There is a time that growth investing works. There is a time that value investing works. There is a time that something else works.
Right.
But over a cycle, if you're consistent with a philosophy, you'll always come ahead of all of these things.
Right.
Whatever your philosophy is.
Yes.
Your philosophy could be that I invest when the sky is blue. It does not matter. If you stick to that philosophy, it will work out.
Right. Yes.
That's simply how most of the investment philosophies work. So
Right.
I'm not going to put a lot of faith in saying is return on equity the best parameter to look for
Yeah,
versus
sure.
a price to book. Maybe there are so many other parameters that you can look
Right.
at.
Yes.
But what is the intuition behind this? The intuition behind this is that instead of concentrating on reported profits,
Yeah.
where EPS growth or what is where most people focus on, is a little bit of an unreliable parameter because reported earnings can be reported for various reasons.
Right.
So you can have accounting issues which cannot be captured properly. You will completely ignore the capital used to generate the profit
Right.
when you purely look at the margin. And there are so many other problems associated with EPS growth. And the fact that you have to estimate growth.
Right.
Now that's
Yes.
a mug's game. It's very difficult to do that.
Yes.
But ROE tells you that this is the capital I have invested. This is the amount of money I'm making on it. I think that's the most intuitive way that you understand how businesses work.
Sure. Sure.
If you go down to a particular business community in this country, that's how they understand business.
Right.
How much money have I invested? How much money am I making on it? I think
Right.
that's how what businesses really need to focus on. We get confused whether it's an IT business, whether it's a vegetable vendor business, whether it's a milk vending machine. All of these things have to be focused on this.
Right.
Whatever capital that you put in, what's the money that I make on it? And that's how the measure of any business is. How profitable are you on the basis of how much capital you're investing?
Right.
Versus what? Versus your peers, versus anybody else.
Yes.
No business really is any different. So this is a very unifying, universal parameter. So I think we have a lot of faith on that.
Right.
Now, obviously, on its own, that may have limited appeal. So you compare it with the universe, And then you say, what is this kind of profitability priced at?
Right.
These are the two real main challenges that you just had to answer
Right.
in the market. And as long as you keep focused on this, and of course we do a lot of work in terms of qualifying ROE.
Right.
So reported ROE can move up if there is a lot of leverage, for example. And there is, if you know the DuPont formula, there is asset turnover as well as net margin.
Yes.
So the higher quality ROE comes from higher net margin and higher asset turns,
Right.
and not leverage.
Right.
So there is a quality ROE that we of course employ, and price to book is price to book for anybody. So PE sometimes gets confusing because EPS, as I told you, reported earnings can be
Right.
all
Yes.
over the place, but PB is difficult to fudge.
Right.
You know how
Yes.
much money in book value you have. So
Right.
what is the price versus anybody's book value? And that erases our issue that certain companies have higher PEs. Here PB is more or less in a much smaller range across the entire universe. So it's easily comparable. So a lot of work has gone obviously within HSBC globally to come up with this one defining understanding of where relative value is at any market across the world. So we really believe in this. We've done this back test across all emerging markets, developed markets. We've also done a lot of work now employing this process within our portfolios.
Right.
And for the last 3 years, we really have seen the benefit. It is fairly pro-cyclical because ROE is a cyclical metric in that sense.
Yes.
And when the cycle moves up like it has done in the last 2 years, it works wonders. So we believe that the focus that we bring to this, yes, tomorrow maybe the parameter may not work for some time.
Yes.
Because each of them will go through some sort of readjustments. And we have seen that happen actually when we began in 2011, that just after we started globally, it didn't work. But we persevered with it, and I think over the last 5 years, we have proved it across our platform that it is a very, very intuitive way at looking at stocks.
Right.
And no matter what you do, these truths, these facts don't change over long periods of time.
Right. Okay, so a follow-up question, and also my final one has to do with exits. And once again, we get a lot of questions about index stocks. For example, in this case, Sun Pharma, which was trading at 1,000 rupees per share a few years ago. It's come down to 500 rupees. How does one decide when to exit?
Well, I will make my explanation a little more broader, because when it comes to individual stocks, it always has something individual about it.
Sure. Yeah.
So you cannot really say, okay, could I have got out of Sun? Practically, no. You couldn't have, because there is no way that you can really estimate such.
Right. Yes.
But as a portfolio, you can definitely do a much better job of deciding when to sell.
Right.
Because what are we doing? Like, for example, when I described my process, I am comparing relative valuation for similar profitability across the entire universe.
Right.
So whenever something really climbs up,
Right.
how Sun would have done at some point of time,
Yes.
would be to indicate that now in my scatter plot, this company is now showing up in the overvalued range.
Right.
And compared to that, for the same relative ROE,
Yes.
I am getting at lower PBs.
Right. Yes.
So my process itself is throwing up opportunities.
Sure.
In fact, in my process, Sun Pharma would now appear as a buy. Now.
Okay.
Because what has happened? Has the long-term ROE of the company changed? Most likely not.
Yes.
It's got a little bit of a wobble in earnings, but if you say that what is the ROE of Sun in the last
Right.
10 years, and it's likely to continue for the next 10, 5, whatever years, I would imagine it's not going to change dramatically.
Right.
The price to book has changed.
Right. Yes.
So clearly, the process will expose this to me as a potential buy now.
Right. Yes.
But the reverse would be true when it goes up substantially and the entire market goes up with it relative to other pharma stocks. If they all move up, my process will not tell me that this is a buy
Right.
or a sell either,
Right.
because I would think that everything is going up, so it's not identifying to me that it is a big sell.
Right.
But if that company only goes up and the rest continue to be a more rational valuation for the same ROE, then it will identify me as a sell.
Right.
So you can see that there are limitations to what we can do even from an intuitive sense.
Right.
And especially coming back to your example of this one company, it's really dealing with that one individual company, and that's what we call as risk in stocks, right?
Yes.
That is individual, or what we call little scientifically as idiosyncratic risk.
Yes.
So that is really specific to that one company, there is no way in the world so far that I have come across that you can really estimate, exits on individual stocks like that. That's why it's always better, because when you buy an individual stock, your relative standard deviation of movement is the highest.
Right.
If I buy two, then I correlate the volatilities of these two, and it brings it down almost to half. If I buy and one more, 3, 4, 5 stocks, then my overall volatility comes down. So the whole point is, while investing in equities, to never really put all your eggs in one basket, because this is a risk that cannot be estimated. Right. That's the risk.
Yes.
But if I buy enough of them, then as a whole, while I make the upside of the average asset class,
right,
I am of course bringing down the return as well, because what one stock can do, obviously 10 stocks cannot.
May not, yes.
But overall, I will still maintain the profitability of the equity class, bringing down my risk almost to only that of the market.
Right.
So when the beta of this portfolio comes close to 1, the risk of the portfolio is just the market risk. There's no specific risk left anymore. That's standard modern portfolio theory.
Right, yes.
So that's how one should look at it.
Well, Mr. Pradhan, it was a pleasure speaking with you.
Thank
you very much for your time.